Welcome to MyAlerts for April 2010. MyAlerts is a service provided by ManageMy401k.com. I'm the Chief Investment Officer at ManageMy401k.com, Steve Athanasi. Thank you for joining me. One of the first steps in following the MyAlerts system is to select a model that's appropriate for your needs and financial circumstances. Some of the considerations in picking a model might be your time horizon. In other words, how many years is it before you'll actually need the money to provide you with an income? Other considerations might be, what's your tolerance for volatility? Or, how much exposure are you comfortable with to equities or stocks? There are three models that are provided in the MyAlerts system: a conservative growth model, a middle-of-the-road growth model, and a maximum growth model. An important consideration is don't pick a model and jump from one to the other. In other words, don't pick the maximum growth model when the market's heading up and things are doing great, and then when things start turning around, jump over to the conservative growth model. What we suggest you do is pick a model, once again, that's based on your needs and circumstances, and then stick to it. I'll share more about how the models work in just a few minutes. Remember, we use a top-down approach in the MyAlerts system. First, we begin by focusing on the overall trend of the market. This is probably one of the most important considerations when it comes to managing a portfolio. The second thing we focus on are asset class rankings. There are 25 asset classes that we follow in the MyAlerts system, and at the end of today's presentation I'll give you the rankings for the month of April. And then lastly, we provide you with a model allocation based on the three models I just discussed: the conservative growth model, the growth model, and the maximum growth model. I'd like to spend just another minute or two talking about the three models. The conservative growth model is structured in such a way that the target asset allocation is 60% stocks, 40% bonds. However, depending on the overall market trend, that equity allocation portion could actually range from as low as 30% to as high as 70%. And lastly, the maximum growth model. The target asset allocation of the maximum growth model is 90% stocks, 10% bonds. The equity allocation in this model could range from 0% allocated to stocks up to 100%, depending on the overall trend of the market. So once again, we use a top-down approach in managing portfolios. That begins with looking at the overall trend of the market. So the question is, how do we report that to you each month? Well, we've designed the MyAlerts Weather Report. What we've done is we've taken all of the technical indicators that we've designed to use in the MyAlerts system and summarized them in an easy-to-use, easy-to-follow indicator. The MyAlerts Weather Report ranges from clear skies at one end of the spectrum to storm warning at the other end. Instead of giving you all of the technical background on why the market's heading in one direction or the other, we've decided it's a whole lot easier to provide you with a simple to understand signal on a monthly basis. So what's the indicator say for the month of April? Well, the forecast for April 2010 is clear skies. All of our technical indicators right now are pointing to a very, very strong market. I just want to mention one thing in addition to the forecast for April 2010. Although the forecast is clear skies, and you need to position your portfolio according to the model that you've selected, which I'll talk about in just a minute, I do want to indicate the fact that our technical indicators are getting stretched to the upside. In other words, it's very possible that in the not too distant future we might see a small correction in the market. Here's a chart of the market, the S&P 500 actually, going back for the past 5 years. I'm going to apply an indicator here that will show you what percentage of the S&P 500 stocks are above their moving average. In fact, the moving average I'm using in this illustration is the 50-day moving average. In other words, when a stock gets above its 50-day moving average, that's a good sign. It's a sign that the trend is upward. However, what sometimes happens when a large percentage of the S&P 500 stocks get above their 50-day moving average, that's a signal that perhaps the market's getting a little bit ahead of itself. Now here's the tricky part. a condition like that could actually continue for an extended period of time. So just because the market's moving up and a high percentage of the S&P 500's stocks are above their 50-day moving average is not in of itself an automatic sell. However, it's just something to be aware of. So once again, here's the S&P 500 over the past 5 years. So with the April 2010 forecast indicating clear skies, what does that mean you have to do with your models right now? Well, if you're following the conservative growth model, you want to be allocated 70% to equities, 30% to bonds. If you're following the growth model, you'll want to have your allocation set to 80% equities, 20% bonds. And lastly, if you're following the maximum growth model, you'll want to be allocated 100% to equities at this time. So now let's shift our focus from the overall trend of the market to the next level down and focus on the asset class rankings. The MyAlerts system looks at 25 different asset classes, including a money market fund. Now, we know that most retirement plans don't have all of these investment options on their platforms. Now, some folks are eligible to have a brokerage account on their platform, and it can invest in exchange-traded funds or a very wide range of mutual funds. If you're fortunate enough to have that, then you'll find this information real helpful. On the other hand, hopefully your 401k or retirement plan has at least some of these, and you can integrate these into the management of your 401k or other retirement plan. The general categories break down into domestic equities, overseas equities, specialty equities, government bonds, and corporate bonds. So here are the MyAlerts rankings for April 9th, 2010. You'll notice at the top of the list, REITs or real estate investment trusts have moved right into the #1 spot. You'll also notice that mid-cap and small-cap are doing very, very well. In fact, mid-cap blend, mid-cap value, small-cap value occupy spaces 2, 3, and 4. Large-cap value continues to perform very well, along with small-cap blend, mid-cap growth, large-cap blend, and large-cap growth. Technology stocks, small-cap growth, and emerging international stocks are in spaces 9, 10, and 11, and 12. Now, the money market fund shows up in ranking number 13, and the asset classes that fall below it are asset classes that you might want to underweight or even avoid completely in the allocation and creation of the model that you're following. Some of the asset classes that fall below money market, most importantly, are the ones that fall right at the bottom. And if you notice, all three ranking dead last are short-term government bonds, intermediate-term government bonds, and long-term government bonds. These have been on the list towards the bottom of the list for the last several months, and in fact, probably a good asset class to avoid. High-yield corporate bonds, also known as junk bonds, have moved down a few spots and now rank in number 17. Mining stocks, developed international stocks or developed countries, international stocks in general, also rank below money market funds. So the only international sector that appears to be doing well in terms of the rankings are emerging countries. So let's take this information now and develop the model portfolio recommendations for April 2010. So here are the suggested allocations for the model portfolios for this month. You'll see here that the conservative growth model is allocated presently 70% to equities and 30% to bonds. You'll see the growth model has an 80-20 allocation, and the maximum growth model is 100% in equities. You'll notice that most of the equity allocations in all three models are heavily weighted towards domestic U.S. equities, spread amongst large cap value and growth, mid cap value and growth, small cap value and growth, with smaller allocations towards international markets and emerging markets. In the bond area, you'll notice in the conservative growth model, we've eliminated the government bond holdings, and in fact none of the models right now hold any government bonds. With interest rates heading up, or at least the prospect of interest rates heading up, that's causing a lot of fear in the government bond market, and more than likely that's why that sector or those asset classes are ranked so low in the MyAlerts rankings. if you're going to allocate any assets towards bonds, right now we suggest you consider corporate bonds and or high yield bonds. In the conservative growth model, we've got a 20% allocation to corporate bonds and a 10% allocation to high yield bonds. In the growth model, we've got a 10% allocated to each, and once again, no allocation to government bonds at this time. Now remember, most plans have a variety of different types of funds, oftentimes in the very same categories. For example, you may have 3 or 4 large cap funds. They're all large cap funds, but they'll rank differently. And what you'll want to do is you'll want to make sure that you screen the funds that are available in your plan to find the best of the funds in their respective category or peer groups. What you're doing by doing this is adding another layer of management. Keep in mind that it's important to do this, but it's not as important as following the MyAlerts system. The most important aspect of what we've talked about today and what the system does is the overall trend of the market. So if you're following the overall trend and the trend right now is up, take a look at the individual funds that you have available, pick the best funds, but don't sweat it if you can't find one fund that doesn't fit one of these categories. In fact, if you can't find an emerging markets fund because you don't have one, then maybe allocate a little bit more to developed international funds if you have one of those. The most important aspect, like I said, is following the overall trend of the market. Now, the next thing is, remember that most plans have now imposed restrictions on short-term trading, usually within 90 days. So make sure you check your plans for any of those rules. And then lastly, if you decide you'd like more personalized help than that which is provided in this video in the MyAlerts system, you can always upgrade your membership to the My Guide program, whereby we provide specific recommendations based on your specific plan that you then implement. In other words, we look at the funds that are available, we do the analysis, and then we specifically tell you what to implement on a quarterly basis. Or, if you'd rather, the My Manager service, whereby your account stays right where it is and we rebalance your account so you don't have to. So keep in mind that if you don't want to do it yourself, those services are available. In the meanwhile, use this information, rebalance your portfolios, and we wish you the best of luck. If you have any questions, comments, or suggestions, you can reach me at sathanasi@managemy401k.com. Thank you.